I'm concerned. For the last couple of years, we've spent most of our time on this YouTube channel dispelling and proving wrong all of the hard landers, the people calling for a recession or depression even, all of the people calling for a bear market, a huge stock market crash. We've proven them wrong, and successfully so. And in turn, we've been one of the most accurate stock market commentators basically in all of the media. And I think that's kind of representative in the way this channel has grown over the past year. If you're not subscribed, by the way, make sure you subscribe down below. Today, I'm not going to change much of my tune, but I am concerned. I'm not going to fearmonger to you about a recession that I don't see coming, but I will fearmonger to you about a market meltup and a bubble that I do see forming. And it's not all that bad of a thing to be invested in the stock market when we form a bubble and we have a market meltup, because you make a lot of money in a very short amount of time. The trouble is, if you're not prepared for it, whenever that bubble pops or whenever that meltup starts to melt down, it's usually too late, and you end up losing all of your gains and then some, and then you try and start chasing some of your gains or chasing your losses, trying to recover those losses quickly by making really stupid short-term bets in the stock market with call options and put options. Why do I say that? Because I've done this in the past. This is my personal experience. I'm a young guy, but I've already been investing in the stock market for 6 or 7 years. And it's really no coincidence that I'm making this video officially on Fed rate cut week. On Wednesday, it's widely expected that the Federal Reserve is going to cut interest rates. It's still up in the air whether they're going to cut by 25 or 50 basis points. You can see that on the chart here. There's a 61% chance right now, according to the futures market, that we will get a 50 basis point rate cut, and only a 39% chance that we will get a 25 basis point rate cut. This is somewhat problematic to me, and I'll give you my prediction. I think in either case, short term, the market's going to have a negative reaction, whether we get 25 basis points or 50 basis points. But that's really not the premise of this video. The reason I believe that is because all of a sudden, the markets have started pricing in a 50 basis point rate cut. If we don't get that and we end up getting the 25 basis points instead, the market's going to be disappointed, and they're going to have to deprice the 50 basis point rate cut. And that in turn makes a lot of stocks sell off naturally. However, on the other hand, if we do get a 50 basis point rate cut, if the Federal Reserve doesn't communicate effectively enough, they run the risk of convincing investors that the Fed is behind again and a recession is imminent. The Fed sees it, and they're making outsized rate cuts because they think the economy is falling through, and that too would result in the stock market falling. But as I started this video off with saying, I'm really not concerned about the economy. I've made countless videos talking about the economy and the jaded or manipulated data points that bears have been using for years and why they are wrong, and how structurally our economy has changed, which renders a lot of recession indicators inaccurate today when they were very accurate in the past. Some demographic things like baby boomers retiring with $76 trillion of net worth with an itch to spend that money. We've talked about it. We've talked about the Buffett indicator. We've talked about all of these things. And my concern isn't economical. It's more to do with the markets right now. We can look at this chart. They're expecting the federal funds rate to fall below 3% before the end of next year. In fact, the markets are pricing in that the federal funds rate will be below 3% for the first time in a while in August of 2025. So literally 12 months from today. In the next 12 months, the markets are anticipating the federal funds rate to fall from 5.25 to 5.5% down below 3.0%. A lot of commentators will look at this and say, wow, that is a really good thing for the stock market. That's a really good thing for the economy. And it is. However, a lot of them are going to stop their research there. A lot of people in the stock market, they'll look for data points that fit their agenda or their thesis, and then they'll stop there. They don't want to do any more research because if they go deeper, it's going to kind of go against their thesis. But that's not what I do on this YouTube channel. What's my problem with the federal funds rate falling below 3%? Well, we need to remember that the abnormality in the economy is not the federal funds rate being at 5.5% like it is today. We can look historically and see that Actually, on average, the federal funds rate has been above 5.5%. The abnormality has been the federal funds rate being between 0 and 2%. That's the abnormality. We've proven in the last 5, 6, 7, 8 decades that our economy, businesses, people, whatever it is, can perform very well with a federal funds rate above 5%. Yet, the Federal Reserve and market participants right now think that we need to send the federal funds rate below 3%. There's this thing in the macro economy called the neutral rate. That's basically where the interest rate, the federal funds rate, is neither stimulative nor restrictive to the economy. It's basically anybody's guess as to where this neutral rate sits, but I think personally, based on the research I've done, that this neutral rate is much higher than it has been historically, and that's for a few different reasons. First of all, let's talk about the upcoming presidential election between Kamala Harris and Donald Trump. Both of their platforms rely on budget deficit spending, which, yes, is very stimulative to the economy, but it also means that inflation is going to trend higher than average over time if we're spending on a deficit and we're stimulating the economy. Further, we have monetary policy now, the federal funds rate that's set to come down and become more stimulative to the economy, which means inflation will trend higher than average over time. And then it doesn't even stop there. There's a third party here, and it's the United States Treasury that is stimulating the economy as we speak. For many months now, the United States Treasury has been financing the government through short-term rates, which doesn't make much sense because that means they're borrowing money at higher interest rates. You see, the yield curve has been inverted, meaning that short-term interest rates have actually been higher than long-term interest rates. If you are a borrower and you're looking to borrow money to purchase a vehicle or a home or whatever it is, typically you're going to take whatever interest rate you can get that is the lowest. And especially if that lower interest rate has a further out expiration date, because it means it's easier for you to finance. Things pop up in your life where you might struggle financially for a year, but by having that debt payment schedule be lower over time and that interest rate being lower, you're going to go with the longer term duration. But the Treasury Department is not doing that. They're borrowing at higher interest rates on the shorter end of the Treasury spectrum, which makes very little business sense, but it's actually because they too are trying to stimulate the economy. And it doesn't even stop there. The Treasury is borrowing money at a higher interest rate, and they're taking that borrowed money and repurchasing their debt outstanding that exists at longer term durations with lower interest rates. Some of this debt, this article here talks about it, was financed or taken out when interest rates were at all-time lows, literally at rates we may never see again. The article talks about it here, how the Treasury bought back some of its long-term duration debt that had a 1.25% interest rate. They injected liquidity into the long end of the yield curve by buying back that debt using new money that it borrowed at higher short-term interest rates. Doesn't make much sense, but here's the strategy. If you issue new short-term debt to buy long-term debt, it's going to keep the long-term interest rates lower. It's going to decrease the yield on long-term debt. So the Treasury Department is making a bet that, okay, maybe eventually we can lock in lower long-term interest rates on our ballooning government debt. That's the bet. Also, this article talks about how the primary objective is clearly to manipulate long-term interest rates lower to stimulate the economy, since long-term interest rates matter much more to the economy than short-term interest rates. If all of that made no sense to you, just take my word when I say that the Treasury Department is also trying to stimulate the economy, and it comes at the expense of higher inflation than average over time. So you can kind of see a trend here. No matter which president gets elected, they're going to spend on a budget deficit, higher inflation over time, monetary policy is becoming more stimulative, higher inflation over time, and the Treasury Department is stimulating the economy, which means higher inflation over time, which means if we have higher inflation, likely the economy is actually growing above trend, but to tame down inflation, to tame down the economy, the Federal Reserve might have to re-raise interest rates again. But that's not it either. We've shown these charts on the channel before, but I think they're so important that I'm bringing them back up. We look at the way goods used to make up a huge portion of our economy, and today it makes up very little of our economy, and how a long time ago in the 1950s, our services economy was very small, but today it's very large in comparison to the goods economy. For example, back in the 1950s, the goods sector of our economy made up 2/3 of our total GDP. Today, that's down to 1/3, and the services sector of our economy has done the opposite, where it made up 1/3 in the 1950s, and it's up to basically 2/3 today. The reason that's a big deal is because the services sector, whether that's producing, whether it's consuming, whether it's investment, whatever it is, whether it's employment, it is much less interest rate sensitive because it's a much less debt dependent sector of the economy. When you produce goods, sell goods, or build a new manufacturing facility, it takes a lot of debt. Margins are razor thin. Balance sheets at companies are very poor. And that means that it's ultimately a less healthy company in general, and again, much more dependent on interest rates. We can look at consumption. Same thing. Services have ballooned and goods consumption has fallen significantly. We can look at industrial production. So this is goods production in our economy. Since China joined the World Trade Organization, goods producing in our economy has been flat. It's been flat. A lot of our goods come from overseas. We ship them into our country. Then we have employment, payroll employment. It used to make up over 30% of total employment in our country, but today that's down to less than 10% of total employment in our country. So the goods sector of our economy has become very small, and the services sector has become very large. And if the services sector is much less interest rate sensitive, it too means that our economy has a higher neutral rate. And then one other note I want to make about this is, as interest rates stay higher for longer, I hate that because I don't think interest rates are high right now. As interest rates stay normal for longer, businesses and consumers, any economic participants in our country, they relearn how to operate profitably as a company or as a person with higher interest rates. They have to relearn, and that means that over time, the neutral federal funds rate also inches higher and higher and higher. So I think you kind of get my point here. I think that the neutral federal funds rate, where the federal funds rate is neither stimulative or restrictive to the economy, I believe that it is actually higher than most other people think. And I'm worried that the Fed also is seeing the wrong thing here. Jerome Powell gave a very dovish press conference about a month ago, and that's what really made investors price in more and more rate cuts over the next 12 months. And it made investors price in lower for longer interest rates over time. Basically, we can look at this and see that investors think the neutral rate of the economy is basically 2.75%. I think that is baloney because, again, historically, we've proven our companies and our people can perform greatly at interest rates of 5% or higher. We've even proven that since 2022. What was the bear argument in 2022? Well, it was that interest rates are going higher and company profits are going to decline as a result, and people are going to run out of money. And that hasn't happened. So both on the short term and the long term, we've proven, our companies and people have proven that a federal funds rate of 5.5%, 5.25%, whatever it is right now, really isn't that restrictive to the economy. Further, we look at any asset class out there. We can look at Bitcoin, we can look at the stock market, we can look at gold, we can look at oil, whatever it is. For the most part, it's trading at all-time highs. Most assets in our economy are trading at all-time highs. When the federal funds rate is restrictive, you don't have asset prices trading at all-time highs. And this also sets up a little bit of a dangerous situation in my mind where, okay, asset prices are already at all-time highs. And if the Fed and the Treasury and our presidential candidate, whichever one wins, choose to continue to stimulate the economy, asset prices are just going to continue to balloon higher and higher and higher and higher and higher until eventually something pops, until eventually that market melts up, turns into a market meltdown. And I think that's the major risk right now, that the Fed doesn't see this the same way I see this, that they think the neutral rate on the economy is between 2.5% and 3% on the federal funds rate, and not between 3.5% and 4% or 4% and 4.5%. And if that is the case, our economy will overheat at some point. And again, riding a market melt up and riding a stock market bubble higher is really a good thing for an investor. We're going to make a lot of money if this happens, but it's something we need to be prepared for well in advance so that we can maybe, hopefully, identify somewhat of a top. So I hope that this video has kind of done that justice. Now, the only way that I can see the federal funds rate falling to 2.75% is if we do get some sort of black swan event like the Great Virus Crisis again, or we get a random recession or depression. That's the only way I can see the federal funds rate falling this much, this quickly, without the economy overheating and the stock market rallying significantly. We can look at the summary of economic projections, and we can see what the Fed projects the federal funds rate to be over time, and basically what they think the neutral rate is. We get an update on this on Wednesday. On the screen here is a chart as of the most recent summary of economic projections release, and it shows you that as of Q2, the Federal Reserve thought the terminal federal funds rate for 2024 would be 5.1%. Over the next year, 4.1%, and then in 2025, 2026, 3.1%. It's pretty consensus right now that these projections are going to fall when the Federal Reserve releases their updated SEP on Wednesday. And that is what concerns me, is that they are going to be actually too dovish, and we're going to see a renewed price inflation. We're going to see the federal funds rate actually balloon to 6, 7, 8, maybe even close to double-digit percentages, which undoubtedly could be, the cause of the Great Recession that people have been calling for a long time now. Now, all of this being said, again, this is not me saying I think the stock market is going to fall short term. This is actually me saying that I think the stock market is going to rise significantly over the next 12, 16, 24 months, but eventually, this bubble is going to pop if things play out how they look or how they're projected. And that's what concerns me. I do think that the markets may fall on Wednesday, no matter what interest rate cut the Federal Reserve decides to go with. But again, I don't have a crystal ball. We've been very accurate on this YouTube channel. Hopefully that continues. But I'm bound to be wrong. I'm due to be wrong. And if you disagree with anything I've said in this video, please let me know. I'm always open to suggestion. I'm always open to discussion and people that disagree with me, because I think it makes everybody sharper when we have these sorts of discussions. And these are the sorts of discussions and in-depth conversations that most people in the stock market don't have. But with that, I hope you guys enjoyed this video. If you did, hit the like button for me. I appreciate it. And if you're new here or returning, not yet subscribed, don't forget to subscribe down below. If you want more in-depth conversation and topics and charts and things like I presented in today's video, consider joining my paid monthly membership. I'm entirely self-funded, I'm entirely independent, and I plan to always be that way. So your monthly support means a lot to me, and you get access to a bunch of awesome perks by joining that membership. But honestly, if you just made it this far into the video, it means so much to me. Thank you, thank you, thank you. I hope you have a great rest of your day. Stay blessed, keep 10 toes to the ground, your chin up. Peace out.